My name is Jonathan Halpern, and I am the chair of the Board of Trustees of the Skyline Apartment REIT. And it's my pleasure to welcome all of you to the 11th annual unitholder meeting of the Skyline Apartment REIT. I'd like to take this opportunity to introduce the other members of the Board of Trustees. I'll ask that each of you stand to be recognized as I call your name. We'll begin with the management appointed trustees, Jason Castellan, Martin Castellan, and Roy Jason Ashdown. We'll also welcome our independent trustees, Robert Bredner, Ronald Durst, Ted Perlmutter, Jeff Newman, and Susan Taves. I'd just like to take a moment at this time to recognize one of our independent trustees who will not be standing for re-election at today's meeting. Ron Durst has been a member of the Apartment REIT Board of Trustees since its inception in 2006. And earlier this year, he announced his intention to retire as a trustee. Having worked with Ron on the board for the past 11 years, I can attest to his dedication, valuable contributions, and hard work. And at this time, or I should say later on in his presentation, Jason will make a special presentation to Ron to thank him for all of his efforts and to wish him well into his retirement as we bestow upon him the honorary title of founding trustee. There will be two components to this morning's meeting. The first, my favorite part, is the formal part of the meeting, in which we'll deal with the resolutions that require unitholder approval. And that includes the appointments of the independent trustees and the appointment of the auditors. Immediately following the formal component, we will move into a presentation, starting with Jason Castellan, Skyline Apartment REIT's CEO, who will be discussing the REIT's performance and highlights of the past year, followed by an opportunity for you to ask questions of Skyline's management team. So without further ado, I'd like to call the 11th annual meeting of the Skyline Apartment Real Estate Investment Trust to order. Firstly, I'll call upon Wayne Bird to deliver the scrutineer's report. Wayne, could you please come? I assume those are fresh, hot off the press.
Oh, they are. I was hoping to hear music. Good morning, everybody. We do have quorum, 18.684% by present and proxy, so this is official.
Thanks, Wayne. We'll note that you have all received a copy of the REIT's annual report along with your notice for today's meeting. You can address any questions you may have regarding the report to Jason and the management team following the formal agenda. Next, we will deal with the appointment of the independent members of the Board of Trustees. Having received no additional nominations prior to this meeting, I would like to present the slate of nominees for reappointment to the board as independent trustees for a one-year term. The slate consists of Robert Bredner, Ted Perlmutter, Jeff Newman, Susan Taves, and Jonathan Halpern. Can I have a motion from the floor for the reappointment of the independent trustees? We'll now move on to the appointment of the auditors for the trust. Prior to making this motion, I'd like to recognize Mr. Tom Gaskell of the auditing firm RLB LLP. Tom, would you mind standing? Thanks, Tom. Can I ask for a motion from the floor for the appointment of RLB LLP as auditors of the trust? The meeting is adjourned. Thank you all very much. I'll now give the floor to Jason Castellan, CEO of the Skyline Apartment REIT.
Thanks, John. Hello, everyone, and welcome and congratulations on another successful year as unitholders of the Skyline Apartment REIT. I'd like to say congratulations to the board. We look forward to the upcoming year, which we already have had a couple of quarterly meetings. We had a draft financial meeting. We've had a couple of phone calls where we've been dealing with transactions over $10 million threshold where we've been discussing. So it's been a busy year already. Jono is a chair for both the board and the finance committee, along with Ted and Bob. We look forward to continuing to work with you, what has been a very productive relationship. New to the board, Susan Taves, a longtime investor and advocate, along with Jeff Newman, who has supported us, been a great sounding board and investor since 1991. Both of you add strength and a new perspective to the work we do, so we look forward to a very productive year going forward. But for today, I'd like to focus on one of the founding board members, as Jonathan had pointed out earlier, Ron Durst. We were first introduced to Ron in our syndication years, which was prior to the REIT, prior to 2006. Ron's experience as a military man, combined with his entrepreneurial success, made him a great candidate as a board member. We asked, he agreed, and since that day that the board was formed in 2006, Ron has been diligent in his duty to represent all aspects of the REIT, including you, our unit holders. By being such a long-standing investor, as well as board member, Ron informed us that he had amassed such a large sum of cash through his investments in the REIT that he felt it was time to resign and start spending some of that money. But before he does, I'd like to call you up, Ron, to the podium if you don't mind. Stand here, Ron. I know what got you early on when you used to come to the syndication meetings were those fabulous cookies, as you always said. We used to serve those at the information sessions, and we hope you enjoyed that. But as we go forward, we would like to, well, we'll give you that now. Thank you. But also what we'd like to do is we would like to recognize you as a founding member. So it's something that you can keep and won't be tempted to eat. So along with that, we have a plaque for you. I'll trade you. Congratulations and thank you very much for your time.
Thank you, Jason, for the words. It's been a pleasure serving for the last 11 years, representing you, the unit holders, in what has been a fantastic journey. Thank you very much for this special recognition.
It's obviously what he liked better, I guess, the cookie. As much as I'd like to take credit for a lot of the things that go on and a lot of the work that went into this management discussion and analysis paperwork and the daily work that goes into this, I have to recognize there's only a fraction of the staff here today, but they represent some of the 700 employees that work across all of our entities and all of our REITs for preparing the report and doing such a great job on a daily basis. Even in the MD&A that you have on page 7 and 8, I think my name got put on the bottom as doing the future outlook when really actually Matt wrote that. So I'd like to thank Matt for that. It's kind of funny that sometimes when we meet someone new and through conversation, it comes about that we're in the real estate business, and the conversation often leads to how is the residential market going, especially more recently, where places like Toronto are seeing outrageous month-over-month and year-over-year growth, or places like Vancouver where they're instituting a foreign buyers tax on homes. This has been pushed into the spotlight. I have to emphasize to those people that, like many of you likely have to defend your investment, that this is a multi-residential real estate investment, and that there's a huge difference between multi-residential versus home ownership. A home is not an investment. It does not pay you each month. In fact, each month you must pay for it and its taxes, its insurance, its utilities, etc. Never mind what is the lost opportunity on the equity that is sitting in your home. A home is an emotional purchase that serves a purpose for many of us here, but in my eye is not looked on as an investment. And although I feel like I just described my children, there's a big difference here between multi-res and the home ownership. Apartment real estate is income generating from day one for our REIT. Apartments we purchase come with income streams already in place. For this, we are paid rent from a wide variety of tenants, tenant demographics based on their age, employment, or the requirement to be mobile and be able to move around. That is really my only point that I wish to make today, so that Matt can go into depth about the REIT and its performance and the strategy going forward. But I want to make this clear, that we make financial decisions on a business based on providing medium and long-term accommodation for our tenants. This focus ensures that the long-term performance of your investment is safe, stable, and secure with us. So on that note, I'd like to bring up Matt to discuss the State of the Union and how things are going forward. So Matt Organ.
Good morning, everyone. So as Jason said, 2016 marked yet another successful year for Skyline Apartment REIT. Success can be measured in many different ways, but as defined by Webster's, success is achieved by having a favorable or desired outcome. When I relate that definition to Skyline Apartment REIT, two measures come to mind: growth and sustainable distributions. Although growth is not a necessity, it is certainly favorable for a number of reasons. By acquiring additional properties and expanding into different cities and provinces, we are able to create further geographical diversification, which can mitigate against local economic risks. Those risks can be devastating to smaller landlords who hold the bulk of their assets in only a few locations. Growth also enables Skyline Apartment REIT to take advantage of economies of scale. With over 16,000 units in nearly 50 different communities, we have the ability to leverage our suppliers to give us the most advantageous pricing and the highest levels of service, and that continues to strengthen as we grow. From the standpoint of taxation, growth is also important. As the REIT acquires properties, the capital cost allowance becomes larger, which allows for a greater proportion of distributions to be made that are non-taxable, which in turn equals happy unit holders. In 2016, Skyline Apartment REIT acquired $160.2 million worth of real estate, which was comprised of 1,153 units over 11 buildings. As of December 31st, the total unit count was 16,304 residential units and 673,000 square feet of commercial space, to give a total value of $1,878 million. For you, the unit holder, the phrase sustainable distributions is the equivalent to a warm blanket on a cold winter's night. It allows you to sleep peacefully. From 2006 to 2016, the distributions have been generated from three sources: funds from operations, proceeds from refinancings, and proceeds from dispositions. It's our goal to have 100% of these proceeds come from operational income. And I know this question comes up year after year. For the past 3 years, we have been very close to obtaining this goal. A key component to achieving this is properly matching our mortgage refinancing proceeds with the REIT's capital expenditures in each given year. We have endured some capital-intensive years as we have improved the condition and the quality of the properties, which has increased the overall value of the REIT. In 2018, our goal is to have the payout ratio less than 100%, and we will continue to improve that ratio going forward after that. Another key financial measure in the REIT's operational efficiency is net operating income as a percentage of revenue. We have been successful in increasing this percentage for the past several years, but as a result of higher utility costs in 2016 and a few other factors, we saw this percentage dip slightly by 0.6% to close the year at 52.4%. But in terms of this metric, 2016 was the second best year since the REIT began in 2006. There's a chart on page 26 of your reports which illustrates this. In order to keep improving this metric, which in turn drives the bottom line, we continue to look for ways to lower expenses and increase revenue. Utilities, specifically hydro prices, have been a newsworthy topic this past year, and it's also the REIT's second single biggest expense. The current Ontario government has responded by announcing rate reductions, which will help reduce our hydro expense for the near future. Unfortunately, these type of subsidies are not sustainable for the long term. So in addition to our standard energy efficiency strategies, such as boiler replacements, toilet replacements, lighting retrofits, over 18 months ago, we began shifting part of the hydro cost from the REIT to the residents by installing sub-meters in eligible properties. When I spoke to you last year at this time, we had just begun having new tenants take responsibility for their own hydro within their suites. As of today, tenants are absorbing $600,000 per year of hydro expense that the REIT has historically paid for. These savings will become greater over time as current tenants move out and new tenants take their place. When sub-metering is fully implemented, the REIT will realize approximately $2 million a year in annual hydro savings. Last year, I mentioned cogen as another means to reduce utility expense. As of today, we currently have 12 combined heat and power units installed, producing an estimated $350,000 a year in hydro savings. Also this year, through a provincial grant, we'll be replacing 330,000 old light bulbs with new energy-efficient LED lights. This retrofit will save the REIT approximately $1.5 million a year, which translates into about $25 million worth of asset value. Where do we see opportunity in the future? With housing prices at record levels across the countries, we see a lot of opportunity for Skyline Apartment REIT. As people, we have two basic needs, food and shelter. And more so than ever before, apartment rental is the least expensive form of shelter. People are simply being priced out of the home ownership market. As a result, our opportunity to renovate older buildings and achieve more rent upon tenant turnover is greater than it ever has been before. We have recently hired a dedicated person to review market rents. This person is analyzing the supply and demand for rental accommodation in all of our locations, and we are making daily adjustments to market rents where opportunity exists. These rent increases can only be realized upon tenant turnover. And the price gap between currently occupied units and units that are newly rented is measured monthly. We call this metric loss to lease. Presently, if all units leased at less than market rent were to turn over, and our most recent capitalization rate was applied to that income, the asset value to the REIT, the additional asset value to the REIT would be in excess of $200 million. Due to the cycle of tenancy and routine market rent increases, the loss to lease gap will always exist, which demonstrates that the value of the REIT will increase steadily without ever making another acquisition. New build opportunities. As you know, the REIT's assets are primarily in smaller cities and towns, which within our industry are considered secondary markets. Throughout most of the REIT's existence, the viability for newly constructed building in these secondary markets was not there, but times have changed. With housing prices high and the leading edge of the baby boomers in their early 70s, the demand for mid-grade to luxury apartment rentals is on the rise. Younger people are being priced out of the housing market, as well as they live a more transient life than generations before them did. The average person now changes employment 12 times over the course of their career. This group of people have jobs and they're willing to pay for quality rental accommodation, and they are not interested in owning a home. Baby boomers, the second group, which makes it an exciting time to acquire newly constructed buildings. The boomers are now in their late 50s and early 70s. Many are empty nesters and have owned their homes for many years, and they're now able to take advantage of a great deal of capital appreciation when selling in this current housing market. A segment of this demographic is looking to break free from the responsibility of home ownership. But just like some of the younger working class, they are not willing to move into an older building that lacks amenities. When there are new buildings in their local communities that have features such as granite countertops, ensuite bathrooms, in-suite laundry, ample storage space, fitness rooms, and areas to socialize, they will happily make the transition from homeowner to carefree renter. A great example of this is the 2 new buildings in Brantford, Ontario that the REIT acquired in June of 2016 and May of this year. Out of the 252 units that we've leased, 84% are leased by baby boomers. And of that 84%, the bulk of them are over 65 years old. I'm sure in your non-biased opinion that you would agree with me. This age group make wonderful tenants. Our acquisitions team is currently working with several developers, and we hope to add approximately 1,500 newly constructed units to Skyline Apartment REIT within the next 24 months. In our lifetime, we can all think of examples of businesses that have come and gone, and many disappeared because they did not recognize the need for change. Complacency often leads to obsolescence. With nearly 600 employees, Skyline Apartment REIT has a diverse and dynamic team of people which are constantly striving for improvement and looking for opportunities to surface value while providing stable distributions for the unit holders. Thank you. I've had a couple conversations sort of pre-meeting here with questions, and of course, often the questions are of common interest to a number of you. So, I'll address those questions first, and then we can field any other questions after that. So, one of the questions I was asked of me is sort of this transition, or not transition, but the opportunity to build new product or purchase new product versus old product, and sort of what are the advantages and disadvantages of that. So, historically, we have always purchased old product because it's what's been available in the markets that we exist in. The advantage, the shift to build some new just comes out of opportunity, and there's certain advantages to that. Obviously, our payout ratio will be a question that comes up, and again, part of our little bit of an influx with year to year with the payout ratio is the fact that we've got to properly balance our funds. We need to sort of mate our capital from refinancing proceeds to our capital outlay for the building for capital projects, and that's generally what we try to do. Certain years, obviously, we have greater refi proceeds than other years, and it's not always a perfect marriage. So if we can't obviously raise through refinancing that way, we have to go to the unit holder and raise units sometimes to do capital. This has certainly helped with asset value of the REIT as they continue to improve, but it is a downside. So certainly with new build, what we don't have is that capital outlay. You've got the opportunity to acquire something new. For years, you don't have the capital expense that you will on the older properties. Another advantage to it is most of the new builds, all the utilities are metered to the tenant. The water, the hydro, sometimes even the gas. So it mitigates against a lot of the expense that may come up in the future, or things that you certainly can't control, like hydro. And that was kind of our Achilles heel in 2016. Hydro costs certainly rose a lot, and depending on the year and the seasonality of it, it's an uncontrollable expense, and we have to do everything we can to mitigate against that for the future. Some of the disadvantages, obviously, to new is where we've seen great appreciation. Some of the older assets is the fact that we can take some capital, put them in older buildings, and because all these older buildings come with existing tenants, many of these tenants may pay $800 a month for rent today. But when that tenant moves out with the money that we've invested into the property, we can then maybe increase the rent to $1,000 or $1,100 or $1,200. So there's a lot of upside on older properties as well. So obviously we'll continue to look for those opportunities where they exist. Any other questions regarding new build versus old? We're not builders, obviously. When I say new build opportunities, we're looking at both, but in the sense of we're partnering with a number of developers that own the land, that will build the building, and at the end, we've got the opportunity to buy it. We also have some other opportunities where we have existing buildings with excess land right now, which again, we will hire a developer to go and build that building for us. And
So we aren't rebuilding buildings.
to a certain degree, we're not looking at, only on areas like that where we have vacant land. Again, it's very dependent on, more dependent on the old building and the condition it's in. But I would say, I mean, Mike can probably answer that better, but it does range. You're somewhere still probably generally between a 5 and a 6 cap. It is. Again, what you don't have obviously is the capital outlay that you've got with an old building for as the asset's new. You mitigate against certain hydro costs and risks on the upside because a lot of the costs are pushed down to the tenant, but you don't have as much upside in building value in the short term as you might with an older property in the right location. Yeah, of course they match, because obviously everything we're purchasing based on the income it produces. So the new build range kind of right now and things that we have acquired, you're somewhere in between $180,000 and $220,000 a door, and rents can range from $1,200 to $1,600, somewhere in that range, depending on where the building is. Yeah, most new build aren't a whole lot different than a lot of the older product in the market. Square footages are going to range somewhere between 700 and 900 square feet, depending if it's a 1 or 2 bedroom unit. No, they're not houses. Correct. They're newly constructed apartment buildings. So sorry, you're asking for a sort of a financial look forward on new build opportunities? Yeah, I think to answer your question, obviously anything that you're seeing in the annual general report is a look back at 2016.
Right.
Obviously, what we're talking about here is sort of future opportunity, and yeah, I think we can certainly make general comments on it. Part of the issue is that obviously, from the time the report's produced and to what's happening currently, what I'm getting at is I think that we can talk about this after, but I think I have an idea of what you want. Let's talk after the meeting here. Right. So currently we're looking at, with the developers that we're partnering with, we've got some new build opportunities in Thunder Bay. We've got some new build opportunities in Guelph. We've got new build opportunities in Peterborough, Port Elgin, and Kelowna, BC right now. Absolutely. Yeah, well, all I'll say about that is we're obviously always looking at opportunities, and we have done that in the past. If you've been with us for a number of years, you've seen the assets being disposed of, and it's a very good point, because there's certain markets that we've entered in years past and improved the assets, and those markets have sort of surpassed what we can actually purchase buildings in those markets for at this point, in order to provide a return. So that would create opportunity to look for dispositions within those areas. Okay, so just if everyone didn't hear it, I'll sort of recap the question. So it was in reference to the new legislation which just came out within the Residential Tenancies Act regarding There's a regarding the post 1991 rent increases. Really is what I think you were getting at there. So up until this point, up until this year, any building that this is within Ontario, any building that was built within Ontario post 1991 was not subject to rent control. Meaning on every other building that we own or anything that's built pre-1991, we're always subject to the guideline increase that the government provides to us every year. That guideline increase is capped at 2.5%, and it applies to existing tenants only. Every year the government rolls out that guideline increase, and it's somewhere between 0 and 2.5%. Anything built post-1991, as a landlord, you were free to go and raise your rent for an existing tenant to whatever you wanted within any of those buildings. For us, we only have a couple buildings that are post 1991, and at this point they're essentially new build buildings, the ones in Brantford. So again, they're rented at current market rents. Where this would be of detriment to us is if for any reason you've got buildings built post 1991 and you had a lot of units drastically rented under market, and you weren't able to, you wouldn't have the ability to get them up to market rent. But that would put us in the same boat as every other property that we have, because most of the other ones, with the exception of the ones in Western Canada, are again built pre-1991. So the impact to Skyline Apartment REIT is it's not material at all. Yeah, currently when a tenant moves out, you can increase the rent to whatever you deem as market rent or what anybody's willing to pay for it. It only affects buildings built post 1991 with existing tenants in it on an annual rent increase basis. They are at this point strictly residential. Not to say if it was in the right location, you may end up with some mixed use, say ground floor commercial, etc. But everything that we're looking at right now and have purchased is strictly residential. Yeah, absolutely. Obviously the majority of the assets within the REIT, we've always approached it from a buy and hold aspect. Anything that we know that we're looking to sell, obviously, we're going to be very careful as to what we spend on that building in terms of capital. We'll do the things that are accretive or will drive value, whether we keep it or we sell it. And then certain other things, obviously, we would try to postpone if we knew there was it was being slated for sale. It changes every year. I think it's 1.5% this year. Yeah, and that's part of the reason, right? I mean, last year, again, hydro was a bit of an Achilles heel for us, and we're trying to do everything we can to mitigate against those costs by sub-metering eligible buildings. So any building that's non-electrically heated at this point, we are allowed through the legislation to sub-meter. And when I say sub-meter, we're putting a meter in, so as tenants turn over, a new tenant comes in, they're responsible for the hydro within those suites. So in combination with that and the lighting retrofit that we're doing this year through the government grants, we're essentially getting the $330,000 or 330,000 light bulbs I mentioned essentially free for a government grant. But that's going to generate about a $1.5 million a year in utility savings. Again, with the cogen units producing hydro again, it's another way to sort of mitigate against our costs with that. Well, it depends. I mean, everything's a negotiation. Some things are a negotiation. If you're an existing tenant and you came to us and you said, I'd really like new carpet in my unit, my walls painted, or a new kitchen, we're happy to open that discussion with you and say we're willing to do this for an extra $30 a month in rent. Yeah, I think you're getting into above the guideline increases is really your question. So obviously, for those of you not familiar with it, when we go into a building, if we acquire an older building and we go in and we put a new elevator in the building, we put a new roof on the building, and if the carpet in the hallways is in shambles and the walls are, need of painting, and we go in and make those improvements, nobody's moved out. We can apply to the board for an above the guideline increase is what they call it. So the guideline being 1.5%, we can, and it's a mathematical calculation. If it costs you, if you spend $2 million on that building, you can apply to the board and say, here's the life expectancy of the items I improved. Boiler replacement would be another one. And it's a mathematical calculation. You'll go and you'll have a hearing. Tenants have the opportunity to speak. You have the opportunity to present what you've done, which is pretty black and white. And generally, you'll be granted the above the guideline increase rate, which whatever, it depends on, again, what you've spent on the building. It may be an extra 2% over the course of 3 years. So you may get your your annual guideline increase of 1.5% plus an additional 2% this year, plus an additional 2% next year, plus an additional 2% for the following, as an example. But this is what you can do on an older building when you're improving the asset. Well, I think obviously you're talking condo sales, right? So, obviously the condo builder is certainly in it to make as much money as they can. And given the geographical location or wherever that is taking place, if they're in a good, strong center, they're able to achieve those. And part of that, again, it's more looked at, I think it more falls into the realm of home ownership, again, because it is a condo. So, housing prices are on the rise, building costs are on the rise, condo prices are on the rise. The correlation between that and what we're building apartments for, I think, obviously the build cost, depending on the quality of the asset, if it's a high-rise concrete, 20-story condo, yeah, it's definitely costs a lot more to build than some of the buildings that we're building. I mean, nothing. A lot of the big public REITs too are in some of the major centers, right? And these are areas which historically we can't get into and still offer the return that we do. It just doesn't fit our model. So at this point, that opportunity nothing's come forth that's been viable. Put it that way.
So some of the questions are very interesting, and they're very specific to certain aspects of the business. I think what would be more beneficial is if we break up with meeting, but yet we'll still wait and circulate so that you can speak to Matt about specific things. Or I know some of you are very more interested in speaking to Wayne about some numbers, or Jay about the environmental, or anybody. We got a lot of Skyline representatives in the room that would be happy to answer a lot of your questions specific to what you're looking at. And I guess if there's anybody that has any more general questions that we could take one more question, and then I could call the meeting, and then we can go on. Do we have one more general question back there? To increase the distribution is quite simply if we can hold the number of units we have outstanding, so the number of unit holders in this room were to stay static, and we earn more money from the REIT. So there's just more money around to distribute to the unit holders that are existing with us. That's pretty simply what it breaks down to. Just more money at the end of the day to distribute for the number of unit holders that are outstanding. So we're working towards that, as Matt described in many different ways here, to continue to get that up. And a lot of the strategies are leading to that. We've been getting that way with just a little bit of a hiccup last year with some hydro being an unforeseen expense that popped up. So, all right, I'll do one more. Well, we still are making acquisitions. We still can have that.
Is it effective cost of capital, the DRIP plan?
Well, the DRIP plan is the same as raising capital, but yeah, we do use that. There may come a day that if we said we're done growing and we're not going to do that, it would make no sense to continue to allow the DRIP to happen. We do know that we are making acquisitions and we're moving forward, so it does assist in capital for acquisitions. Yep. And the DRIP is relatively a small number, a very small number for compared to what we would raise to go ahead and make an acquisition. So I'd like to thank Matt for all his insight and information on the year. And I'd like to thank again the board and all the management and all the Skyline team that's here today. And everybody's here to help answer questions. And most of all, I again want to thank you all for your support. And you know, just I think this is a great relationship that we have with our unit holders, and although this is a formal setting today, I hope to see you at some of our other informal events that we have throughout the year. So with that, thank you very much everybody for today, and prosperity to 2017.